You'll owe the difference when you file, but no penalty. This is huge because it means you can use last year's tax as a baseline, especially if your income is unpredictable. You know exactly what to pay, and you're protected. Form 1040-ES. The IRS provides Form 1040-ES to help you calculate and pay estimated taxes. You can download it from irs.gov. It includes a worksheet that walks you through estimating your income, deductions, and credits to figure out your quarterly payment amount. The form also includes payment vouchers if you're paying by check. Each voucher has a space for your Social Security number, the tax year, and the amount you're paying. You'd mail these with your check to the IRS address listed for your state. But honestly, most people don't mail checks anymore. How to actually make the payment? The easiest way to pay quarterly taxes in 2026 is online through the IRS Direct Pay system or the Electronic Federal Tax Payment System called EFTPS. IRS Direct Pay is completely free. You go to irs.gov Payments, select Direct Pay, and you can pay directly from your checking or savings account. You'll need your Social Security number, your filing status, and the tax year you're paying for. It takes about 5 minutes. EFTPS requires you to enroll first, which takes about a week because they mail you a PIN. But once you're enrolled, you can schedule payments in advance. And this is great if you want to set up all 4 quarterly payments at once and not worry about forgetting. You can also pay by debit card, credit card, or digital wallet, but there's a processing fee, usually around 2%. If you're paying $2,000, that's a $40 fee, so I'd skip that unless you're getting valuable credit card rewards. Penalties for not paying. What happens if you don't pay quarterly taxes? The IRS charges an underpayment penalty, which is basically interest on the amount you should have paid. For 2026, the interest rate is around 8% adjusted quarterly. Let's say you should have paid $2,000 on April 15th, but didn't pay until you filed your return in April 2027. You'd owe interest on that $2,000 for an entire year, which could be $160 or more, depending on the IRS interest rate. And it compounds. If you skip all 4 quarterly payments and owe $8,000, you're paying interest on each missed payment for the time it was outstanding. This can easily add up to several $100s. The safe harbor rule protects you from this penalty, which is why it's so important. All right, let's recap what you need to do right now. First, figure out if you need to pay quarterly taxes. If you're self-employed or have significant income without withholding, the answer is probably yes. Second, mark your calendar with the 2026 due dates, April 15th, June 16th, September 15th, and January 15th, 2027. Set reminders a week before each deadline. Third, calculate your payment amount. Use last year's tax as a safe harbor baseline, or estimate based on your projected income this year. Fourth, set up your payment method. Go to irs.gov and use Direct Pay, or enroll in EFTPS if you want to schedule payments in advance. And finally, make your payments on time. Even if you can't pay the full amount, pay something. The penalty is based on how much you underpay, so paying 80% is better than paying nothing. Quarterly taxes might seem annoying, but they're actually a good thing. Instead of getting hit with a massive tax bill in April, you're spreading it out over the year. It's easier to budget, and you avoid penalties. If you found this helpful, make sure to subscribe to Tax Strategy Lab. I'm breaking down self-employment taxes, deductions, strategies, and all the stuff you actually need to know as a freelancer or business owner. No fluff, just practical information you can use. Drop a comment if you have questions about quarterly taxes, and I'll do my best to answer. And if you want me to cover a specific tax topic, let me know. I'm here to make taxes less confusing. Thanks for watching, and I'll see you in the next one. The IRS penalty for not paying quarterly taxes can cost you hundreds of dollars. And here's the thing, most people don't realize until it's too late. If you expect to owe more than $1,000 in taxes when you file, you're probably supposed to be making quarterly payments throughout the year. I'm going to walk you through exactly who needs to pay quarterly taxes, when they're due in 2026, how to calculate what you owe, and, most importantly, how to avoid those nasty penalties. Let's dive in. So first, let's talk about who actually needs to pay quarterly estimated taxes. This isn't just for business owners or traditional self-employed people. You might need to pay quarterly if you're a freelancer, a gig worker driving for Uber or DoorDash, a consultant. You have rental income, you're trading stocks frequently, or honestly, if you have any income where taxes aren't being withheld automatically. Here's the general rule. If you expect to owe $1,000 or more in taxes when you file your return, and your withholding and refundable credits won't cover at least 90% of your current year tax liability, you need to make quarterly payments. Now, if you're traditionally employed and just have a little side income, you might be able to avoid quarterly payments by adjusting your W-4 at your main job and having more withheld from each paycheck. But if you're primarily self-employed or your side income is substantial, quarterly payments are going to be your reality. The reason the IRS wants quarterly payments is simple. They want their money throughout the year, not all at once in April. When you're an employee, your employer withholds taxes from every paycheck. When you're self-employed, you're responsible for sending in those payments yourself. The 2026 quarterly tax due dates. Let me give you the 4 quarterly due dates for 2026. You'll want to write these down or set reminders right now. First quarter, April 15th, 2026. This covers your income from January 1st through March 31. Second quarter, June the 16th, 2026. Notice it's June 16th, not June 15th. This covers April 3rd through May 31. Yes, it's only 2 months, but that's how the IRS divides the quarters. Third quarter, September 15th, 2026. This covers June 3rd through August 31. Fourth quarter, January 15th, 2027. This covers September 1st through December 31, 2026. If any of these dates fall on a weekend or holiday, the deadline moves to the next business day, but these are the standard dates you need to remember. How to calculate your quarterly payment. Now, how do you figure out how much to pay? This is where it gets a little tricky, especially if your income varies from month to month. The simplest method is to look at your previous year's tax return. Let's say you filed your 2025 return and your total tax liability was $8,000. Divide that by 4 and you'd pay $2,000 each quarter. This is called the safe harbor method, and I'll explain why it's so important in just a minute. But what if your income is going up this year? Let's say you made $60,000 in 2025, but you're on track to make $80,000 in 2026. If you only pay based on last year's numbers, you'll have a big tax bill in April, so you might want to estimate based on your projected income. Here's a rough calculation. Let's say you expect to make $80,000 in self-employment income in 2026. First, you'll owe self-employment tax, which is 15.3% on 92.35% of your net income. That's roughly $11,400. Then you have income tax. After the standard deduction of $15,000 for single filers in 2026, you have $65,000 in taxable income. Based on the 2026 tax brackets, that would put you in the 22% bracket, with total income tax around $8,000 to $900. Add those together, $11,400 plus $8,900 equals about $20,300 in total tax. Divide by 4 quarters, and you're looking at about $5 to $75 per quarter. Now, I'm simplifying here because everyone's situation is different. You might have deductions, credits, state taxes, or other factors. But this gives you a ballpark, the safe harbor rule. Here's where the safe harbor rule becomes your best friend. The IRS has a provision that says if you pay either 90% of your current year tax liability or 100% of your previous year's tax liability, whichever is smaller, you won't face underpayment penalties. There's an exception. If your adjusted gross income was over $150,000 last year, or $75,000 if married filing separately, you need to pay 110% of your previous year's tax to qualify for safe harbor. So let's use a real example. Say your 2025 total tax was $8,000 and your AGI was under $150,000. If you pay at least $8,000 in estimated taxes throughout 2026, either through quarterly payments or withholding, you're safe from penalties, even if your actual 2026 tax ends up being $12,000.